Well, results out of listed fund manager Coronation this morning show a hefty 80% rise in revenue to 655 million rand for the 6 months to March. Diluted headline earnings a share rose 221% to 64.8 cents. Of course, this was in line with guidance provided by the group last month. Assets under management have grown 13.5% to 176 billion rand over the past 6 months. Joining me with more is Hugo Nelson. He's the CEO of Coronation. Hugo, thank you very much for coming in this afternoon.
Pleasure to be here.
Hugo, great growth, but to put it into perspective, March last year was really the dregs of the market. Everything was down, and you could only benefit from those markets as they started to catapult back up again, couldn't you?
Yes, no, that's true. The comparable base was incredibly depressed, and over the last year we've seen markets recover significantly. All the risk aversion and fears of Armageddon that I think we spoke about 12 months ago seem to have abated, although obviously jitters at the moment in Europe, but significant market recovery, and in actual fact on a year-on-year basis our assets under management are up in the order of 45% or just over. So that's really contributed to that strong revenue performance in comparison.
How were you positioned in March last year as the market started to rebound? Did you invest fully in equities, full exposure?
Yes, actually that's true. We not because we anticipated the recovery as quickly as it happened to occur, but we did position where we had the latitude, because we don't have that latitude in all funds.
Of course.
But with respect to balanced mandates, we did invest fully in equities. By the time we got to March and the lows, we were fully invested in equities. And as I say, not because we knew that the markets were going to bounce, but really because valuations were so incredibly depressed. Safe assets were terribly overvalued. So, developed market government bonds were trading on incredibly thin yields, and risky assets or equities were, nobody wanted to own them. And so we were fully invested in equities at the time, and the results show that.
Of course, one could argue now, at least a couple of weeks ago, that valuations were looking a little bit stretched, have come off significantly this week, but the market's a bit more volatile at this stage and we're not quite sure where it's going from here. I mean, what's your view on that, and how would you be positioning your equity portfolios and your balanced portfolios going forward from this point?
Yeah, our view at the moment is that markets are not, while we would have said a year ago markets were terribly undervalued, at the moment we wouldn't say that. We don't think, but by contrast, we don't think that markets are overvalued. We think that at the moment the domestic market is fairly valued, and to some extent, given Rand translation, that developed markets are actually fairly attractive in valuation terms. So we wouldn't be underweight equities at the moment, but we wouldn't be as overweight as we were in March, April of last year.
How about investors perhaps getting a little bit skittish with the markets at this stage? What would your advice be to them? Because of course you do invest over a long-term time horizon of at least 5 years, don't you?
Yes, and I think that it's all obviously relative to the investor's time horizon and their expectations and their return needs. The bottom line is that if you're wanting inflation-beating returns, you need to be in riskier asset classes than cash and bonds. The unfortunate reality is that over the last year, many investors were actually too conservatively positioned for their return needs. And with the kind of volatility that we're seeing, it always introduces uncertainty into the mind of investors as to when they should, be exposed to riskier asset classes. I think it's part of the reason why we are in favor of providing investment solutions to clients. In other words, balanced orientated solutions where we take some of that anxiety away and make the asset allocation decisions on behalf of the clients. I think the reality is that even from these levels, if you're thinking sort of 5, 10, 15, 20 years hence, you need equities in your portfolio. You're not going to get inflation beating returns by being in cash, and there's still a lot of money sitting on the sidelines, not just in South Africa but around the world, sitting in cash because of the uncertainties that people have been living through, essentially.
Of course, your own performance has far outpaced what we've seen on the market, and you've won a number of accolades for that. Are we looking at investment performance here? You've grown assets under management as well. Chat to us a bit about that.
Sure. Assets under management ended at 176 billion Rand. This is at the end of March, and that compares with about 120 billion at the end of March 2009. Markets are up about 44% over that time. So markets contributed quite a lot to that movement. In terms of the flow experience that we experienced, we received positive flows in this half of 4.5 billion rand. And that's largely in the retail side of our business, or the unit
So
trust
the retail
side of
side's growing quite nicely then.
Yeah, in the unit trust side of our business. And that's also a question of base, because it's it's roughly 20% of our assets under management sit on the retail side. In terms of the investment performance, almost regardless of mandate or asset class, we've delivered ahead of benchmark or required rate of return for our clients. But we've also, the last 2 years have been incredibly volatile, and for an active asset manager, that actually creates opportunity, because the more mispriced assets are, the great opportunity there is to add value to your clients. I think if you end up in a situation where assets are more fairly priced, that does become more challenging. But as we've just said, the volatility persists, and so while that might be unsettling for sort of investors with a shorter term horizon, it's not necessarily bad news for an active asset manager, and not bad news for our ability to deliver active returns into the future.
Well, how have your performance fees benefited from these active returns that you have been delivering?
Yeah, we're pretty kind of fee agnostic, in the sense that we don't really mind whether clients wish to pay us on a fixed fee basis or on a performance fees, or a term which I guess one could talk about incentive fees. So we're quite happy to risk share with clients. And so what that means is that if we go through periods of poor performance, we're quite happy to earn less. And when we go through periods of very good performance, we want to deliver good net returns to clients. And as we do that, our revenue line benefits. And so roughly speaking, when you look at that 80% growth in revenue, and I've already said that markets delivered 44%, the remainder would really relate to fees earned on the back of performance which we've delivered ahead of client expectations, which really we think is a good alignment of interest.
Prospects for the second 6 months, and where are you seeing value? And I know you're saying that the markets still look fairly priced at this stage, but where are you seeing value?
Yeah, it's not as easy as it was a year ago, 12 months ago. We in our client equity portfolios are emphasizing global businesses which just happen to be listed on the Johannesburg Stock Exchange. So, for example, the MTNs of this world, the South African breweries of this world, the Sassels, etc. These are businesses listed on the Johannesburg Stock Exchange, but they earn their revenue as a function of
also Richemont's, Liberty International's, British American Tobacco.
Exactly, and so those businesses dominate in terms of our equity portfolios, and at the same time, we are starting to be interested, I think, in the bond market. We're not hugely positive on on sort of government bonds globally.
Particularly Greek ones.
Yeah, particularly Greek ones. But other forms of other debt issuers have sort of been tarred with the same brush. So, for example, corporate issuers, and many corporates are in a very healthy state with respect to their balance sheets. Inflation-linked bonds, also perhaps issued by corporates. So these are starting to look interesting, and we're not sort of overly exposed to some of these assets, but within this kind of spread of opportunities, we see opportunities in those areas.